Again, thank you. So today's session is about top 12 profitable trading systems. So I use these trading systems. I will explain to you in summary of all these 12. Plus, there are a lot of other things which you need to know in order to be successful in trading. So let's see if I can explain to you what is required. And so when you're done listening, maybe some aha moments, something clicks that will guide you further and you improve your trading. So the most important, there are three ingredients to trading success. So the first one is you, meaning you or me. I am responsible for my own trading, so I'm the most important factor in my trading success. People don't realize how important it is because everybody is wired differently. So me and you are, everybody is wired differently, and we perform or think, act, react differently in every day in whatever we are doing. We react differently. So in the same way, in the trading, we react differently. So the most important factor, and the experts say that 60% of your success relies on you yourself. Then 28% of the success goes towards risk management, which is the risk management can be comprised into two part. One is how much, and the second is where. How much to invest and how much to lose. So these are the two questions which trader needs to ask in the risk management. How much I'm going to um, risk. So how much I'm going to risk in a trade, and and then how much I'm going to lose in the trade. So how much I'm going to lose and how much I'm going to risk tells us how much I need to invest based on my risk profile and my portfolio size. So this itself, risk management is a different topic. So I explain a little further in other sessions. So just so you know, risk management contributes 28% towards your success. So you contribute 60% and 28% is coming from your risk management. This risk management factor can be you can create a simple system on an Excel worksheet or a notepad, etc. So to begin with, so at least you have a notepad or Excel worksheet to create your risk management system. So 60 plus 28 is 88. The 12% of your trading success comes from your trading system, your what you're doing, how you're trading, how you're reading the charts, how you are finding your trading candidates. So 12% contributes um, towards your success. So if you add, these are the 100%. So 60% is you, 28% is risk management, and 12% is the trading system. And the trading system which fits your trading style, your trading objective, not just any trading system. You have to know what kind of a trader you are, what kind of a person you are, what you're trying to accomplish, what is your portfolio size, what is your risk profile, what else is going on with your life, how many multiple streams of income do you have, or are you is if the trading is for growth of your portfolio, or you're trying to mm, create uh, regular income. Are you a long-term trader, short-term trader, swing trader, day trader, scalp trader? Whether you're trading stocks, whether you're trading options, what are you doing? So ask yourself how many accounts you have. Do you trade stocks in a different account, options in different account, etc., or you just mix it? Do you have time to trade during the hours? So do you have um, are you tech savvy? What is your age? People may not be quick to even move the mouse. I mean, so think about it. Maybe you cannot execute quickly. So all that goes into your trading success. So only you know what is going on and how many family members are there with you, etc. Maybe you are just. I have members who drive truck, and they are my members. So they drive truck, they have internet in their truck. So a person who's driving truck in somewhere on a freeway is a different than a person who is in his home office and trading full time with 14 monitors. So think about that. So all that goes in your trading success. So the most important factor is you. So this topic is big topic, You have to do the research, uh, and there are books. Maybe you passed an age where you say, no, I just passed that age, and I don't need to improve. So maybe you reach that stage. So the most important factor, but I'm just letting you know, the most important factor in your trading success is you. Then after, so 60% contributes you factor. Then also the related to you have three components, which I explain in other sessions in a deep dive. Not a deep dive like an because I'm not a psychologist or the person who is specialized in this area. So what I learn, I'm teaching you, and I cannot teach everything what I learned. So I'm just giving you the ideas. So it's a different session. So you can attend a different session or go to YouTube and find the session related to this area. There's a course I have, which I it's an 8-day course, and I suggest you attend that course. Take that course. For me, it's uh, where I teach these in a deep level. So contact my team for enrollment if you're interested. Anyway, so you have beliefs. You have beliefs on your capability. You believe in a certain environment. You believe on you have spiritual beliefs. You have your identity belief. So my spiritual beliefs playing role in my trading. Your spiritual, if you ask a monk um, to trade, so he will say, no, I don't need to trade. um, I'm a monk or a priest. So think about that. Um, they have different point of view for the money. Whereas if you ask someone else who have he has his spiritual beliefs, and it teaches him that money is not evil. So he will think about a market differently, about the money differently. So so think about this. So me and you have different beliefs. The beliefs are we adopted these beliefs from the day we are born. My family is different than your family. The place I grew up, different. The circumstances happen in my life is different. So all those things which happen in my life is affecting my trading also. So think about that. All the things which happen in my life are affecting my trading. So I am viewing my trading differently. I'm approaching trading differently than you are approaching. Now, the way I learn so my personality is different. I have a different view about the market, different beliefs about the market. So this is just a little, no, 6, 7 points. There could be thousands of points, thousands of beliefs towards the market, how I'm acting, what belief I have, what beliefs bring in the market when I'm trading. So I give you just example. So you may have a belief. I'm sure that candle is telling me something. So you see a candle, and you say, okay, it's on a 5-minute chart, and then you say, okay, it's telling me something. So something maybe, okay, the market is going up or the market is going down. So that beliefs make you react towards that symbol. I'm sure stochastic is giving me sold out reading. So you monitor stochastics, and then it says, okay, sold out reading. So you react, sold out reading. So I may go long, or I close my short position. So maybe you can think like that. I'm sure this moving average will hold. So maybe you have a system, moving average system, where you say, okay, so it is on 50-day moving average. So this 50-day moving average will hold, and I have a position and I should hold. So you have this belief and you hold, even though you see that the market is tanking. So I think the market will tank soon. So you have all the long position, and then you close it because you bring this belief that you think that the market will tank soon. So you close out all your long position, and the next day the market just moves up and up. So think about that. I'm sure market is telling me something. So you're trying to figure it out what the market is telling. It's telling me something. I don't. You don't know what's telling you. It's telling you something. I'm more successful in downtrending market. So you bring this belief that I will only trade the downtrending market because the stock falls fast and I make money. The other kind of market I'm not going to trade. So you left out with the uptrending market or the sideway market. I'm sure T-bills are going to have a major correction shortly. So you think T-bills are going to have a major correction shortly, is going down. So you think the market is will go up. So you position yourself. Or maybe you have a contracting belief. You're saying, I think market will tank soon, and you have another belief. I'm sure T-bills are going to have a major correction shortly. So maybe you bring two beliefs in the market, and they are conflicting beliefs. So think about it. All these beliefs you're bringing, which may be useful, which may be garbage, which may be conflicting. So think about all the beliefs you bring in the market. So thousands and thousands of beliefs we bring in the market, and we trade accordingly. So this is important. And then we have a mental states. So different kind of market, different kind of situation requires a different mental state. So what kind of mental state do you bring in the market? What kind of mental strategies do you bring? Do you access the internal resources? So there are external resources and internal resources. So do you access internal resources when you are trading? So you have beliefs, you have mental state, and then you have mental strategy. So these three comprise the factors uh, um, which relates to you. So to you is belief, mental state, and mental strategy. And this you contributes 60% of your trading success. So I explained to you belief. So you need to do the research on belief, mental state, mental strategies. And when you combine those three, your emotions, etc., gives you 60%, contributes 60% towards your success. Now, another factor which plays a very important role is the understanding of the market. So what the market is doing. So if we come to the market without understanding the situation in the market, then we have a high chance of failure. So think about all kinds of markets out there, whether it's a choppy market, whether it's uptrending market, downtrending market, sideways market. Sometimes it goes up, sometimes it goes down. There is no strength in the market. So think about what kind of a market uh, you are trading, and whether you are mentally fit for that kind of a market. Maybe you just um, you are not ready to trade that market. So maybe your portfolio is not you have not created a portfolio, or maybe you have not allocated certain funds which require to trade that the market, the kind of market. So market could be uptrending market, could be downtrending market, and could be sideway market, and it could be a volatile market, it could be a normal market, quiet market. So different kinds of markets. So are you aware of the conditions of the market? So think about this. Now, another component of your trading success is a trading system. So what kind of a trading system do you have? So I will explain to you those 12 trading system in a summary format, because this is a big area. So not only the trading system you have, what kind of trading system you have, and is it for going long or going short or sideways? So think about that. Maybe you have only the long trading system. So you can only trade when the market is bullish. Maybe you have a system for short, uh, going short, so you can only trade short. So think about that. Even though you have a long trading system which only contributes towards the long side of the market, upward side of the market. So think about that. If you have this, then are you putting so you say, okay, this trading system is only for, I am good in trading on the long side. So the market is going down, so you say, okay, I'm going to sit on the side. So are you putting a limit on yourself that first of all, you're putting a limit that you don't trade on the short side, you only trade on the long side. So that's one limit. So we put the limit on ourselves. Another thing, even if you trade, if you master on the long side and the market is going down, then figure it out. The symbols, the inverse, those symbols, those market which goes opposite. When the market tanks, they go up. So maybe you can trade. So you need only one kind of a trading system. Master the one kind which is uh, towards the long. And when the market is going down, you're trading the inverse symbols or stocks. So think about this. Now, so there are so many trading systems. I'll explain to you 12. So so you have to so you can master all 12, you can master all the hundreds of out there. There are hundreds and hundreds of trading system based on chart pattern, based on technical indicators, based on candlestick, based on trend line breakout. There, you name it, there are systems. So can you trade all of them? Maybe, I don't know. But then you say, okay, no, I will figure it out. What is the key trading system which fits me and what I'm trying to accomplish? So you only master those trading system which fits you and which you where you believe in it. So think about that. Identify those trading system which you master it and believe in it. So now we talked about the U factor U, which is a big area. You have certain beliefs, you have certain mental state, you have certain mental strategies, and then you have you're mastering the trading system. So you identify those key trading systems, your techniques. I will explain to you more, and you apply those trading system strategies, techniques, indicators towards your trading. So when you um, so there's a market here. So think about this. This is a Venn diagram. So this is a market, and this is the trading system. So if when you combine the two, then this area, this common area. So this trading system which you're using, whether it's a visual, a chart pattern, or a black box, has to fit this kind of a market. So it means this trading system does not is not fitting the other kinds of markets. So only fits a certain kind of a market. So when you that kind of a market condition exists, and using this your techniques, the skills you acquired, then you and laser focus in this area, that's where you make the money. So the moment, if you're using the trading system, and the moment the market drifts away from the conditions which suits this trading system, that's where your failure comes faster. So this is where the failure comes faster, because your trading system is not suitable to to handle this kind of a market. But we keep using the same trading system for the market, even though the market has changed. So we are not trading this in this area. So the cross section of the trading system in the market. So think about that. Now, another point is the types of trading. So what kind of a trading you are trying to accomplish? Are you a scalp trader? Are you a day trader? Are you a swing trader? Are you a position trader, long-term trader? So as we move this way, clockwise, the time horizon goes up. So maybe it doesn't fit all of you. So maybe you're not a scalp trader. Maybe you're not a day trader. Maybe you're just a swing trader. So think about this. What kind of a trader are you? What kind of trading you are doing? So this, you should fit one of these five. Maybe there are other kinds of trading. Maybe so you may not fit for scalp trading. You may not fit for long-term trading. So think about this. You and maybe you don't even have an account which fits this style of trading. So the types of trading you're doing also need to fit. So now we talked about you, which has a lot of factors, including beliefs, mental state, mental strategy. Then you're talking about the trading system. So you're talking about the market. So many kinds of market, the sideway market, upward market, downward market. Then there's a volatile market or a quiet market. And then you have to ask, where is the most potential for me to make money? Is it in the volatile market, or is it in the quiet market? So, or is it a downtrending market? So if it's a downtrending market, then is it a quiet market, or you want a volatile market? So think about that. Then what kind of a trading system you will use, which I will explain to you. And then what kind of trader you are. So think about this, what kind of trading you're doing. Then the trading strategy on top of, after that is a trading strategy. So trading strategy, are you trading stocks? Are you trading options? Or what you're trying to, what trading strategy you are adopting? So if you are a day trader, you would have a different trading strategy. You would have a different time interval to focus. If you are a swing trader, you have a different time interval. If you're a long-term trader, then you have a different time interval. So if we are not aware of our what we are trying to accomplish, what kind of a trader we are, we can be reading different time frame. So think about this, that what kind of a trading strategy you are adopting, and whether you're trading stocks or options or futures and what. So when we combine the cross section of the three, the market, the trading system, and the strategy. So now our focus is further narrowed down, because this the what we the system we are using, the kind of techniques we are adopting needs to fit the kind of market we have, and the trading strategy we are using needs to fit also. So now our area is further focus. So you're laser focused only in this area where the market fits the trading system you're using, and the trading strategy you're adopting has to fit also. So now you are laser focused. So instead of this whole universe, you just laser focus in that area. So these three. Now, so let's say I'm a swing trader. So I'll explain to you swing trading. What is swing trading? So swing trading is a speculative trading strategy where we hold from 1 to 7 days, a short period, and we can only trade the active markets because it requires a quick move. So you trade only the active market. You also need to trade the liquid market where the volume is high, 1 million on average the stock trades, may be active, maybe the spread is very narrow, and which the stocks constantly have news in the market. There is some catalyst for that stock to move up and down. So think of, you don't want to, in swing trading, you cannot trade the dull stock like AT&T or Verizon or something like that. So in other words, you have to, out of 9,000 stocks, now you need to bring down selected stocks. So you have to, your focus is now, you're bringing your focus even narrow. So to think about that. And then the beauty of swing trading is, so I explained to you swing trading, the beauty of swing trading is the combination of two concepts. So it's like slower pace of investing because you're not doing the day trading. So in investing, you buy something and you hold it. But in the swing trading, you holding it for some 6 7 days, but it's you're acting as a day trader. So when you are selecting the stock to trade for or option to trade, you are acting as a day trader to time your entries correctly. So when you time your entries correctly, you have to adopt the process of stocking. So you have to remind yourself, even though I'm doing this swing trading, I should act like a day trader. So when we remind ourselves that I need to act like a day trader, then we will be triggering the process of stocking. So when we create or trigger the process of stocking, then we have to say, okay, the mental state. So the mental state is of patience. So we need to be patient. I'm stocking it to reduce my risk, and reducing the risk is another different topic. I can double my profit and reduce the risk. So all that process is going on behind the scene, and you are monitoring that symbol on a lower time frame. So you have to remind yourself, I need to go down a lower time frame, which is as low as 5 minutes. So this is the swing trading combination of two concepts: slower pace of investing and quicker pace of day trading. And reminding ourselves that we are, even though we are a swing trader, we need to act like a day trader. And in the swing trade, you're anticipating the next move. You'll get, before the stock makes its move, a big move, you're anticipating that move based on the system you're using or the techniques you have, the skills you adopted to achieve the head start. And you're understanding the reaction. So maybe you have a process of understanding how this stock react. So if you're laser focused on, let's say, only the top 100 stocks, I'll give you some name. So you know how it reacts because you trade on a regular basis. Maybe you have a system of support and resistance, so you know this is a strong support and the stock is reacting according to this already support, the strong support established, or it's reacting based on the resistance. So you're buying and selling correctly. Your targets are set correctly. You're understanding the support and resistance. So all this, understanding the support and resistance, understanding the volume, understanding the reaction, reading the news correctly, you're positioning yourself for that stock, and you're looking for a quick move. So you're looking for a quick move and your holding period is 1 to 7 days, and you're acting like a day trader where, for your entries, where you're stocking it and reducing your risk and increasing your profit. So all that goes on in the swing trade. So what is the objective of swing trading? Is to maximize profit in a short period of time and minimize the downside risk. So these are the two objectives. Now, when we you can do the swing trading in the stocks. So you're looking for 3 to 7% profit. So you're looking for a quick move, so you buy at 100 and maybe you're selling it, your target is 107, or the first target is 103. So you're looking for 3 to 7% move. So when you're trading a stock, you're looking for 3 to 7. But when if you take the same stock and your timing is correct, when you transfer, instead of a stock, you're trading options. The option have a leverage and it has a double-edged sword. So there is a time decay concept. So if your reading is correct and the stock moves, instead of 3% gain, you have in option trading, you have a 40% gain. Instead of 7% gain in the stock, you could have 100% gain. So, and you can have a loss also. So the gain and loss is equal. So the stock trading 3 to 7%, option trading 40 to 100%. The if you're reading it in the chart. So for swing trader, so who is the swing trader? How is he trading? So for swing trading, you don't need a perfect indicator, because that perfect indicator, when it aligns and give you the signal, maybe that is not, that stock has gone beyond the swing trading objective. It's set up for a long-term trading, and your stop loss is way far. So there is no need for perfect indicator. You trade the system fitting your trading style. So all the trading systems out there, the chart pattern, the trend system, the breakout system, the reversal system, all the system, and I will explain to you 12 of them. You trade those system fitting your trading style. You identify the proven pattern. The pattern, if you're a pattern trader, or a bar or a candlestick trader, you are identifying the proven pattern. You have seen it before and you are seeing it again and you believe in it, and you are executing the same techniques daily. You have the same trading rules, you have the same checklist, you go through the same time interval for your entries and exit, you have the same way of evaluating the target. So every day you're doing it the same way, every day the same way, and you're laser focused on the basket of stocks. Maybe there are only 200 stocks, so you laser focus on that. You, over the time period, you have developed the expertise, judgment, and skills, and you're applying it, and you are flexible. So um, if you set the target for 7%, let's say 100, instead of 100, you entered at 100 and exiting at 107, you are, so it's if it's not, 5 days have passed and it's not gone to 107, maybe you say, okay, I will exit early, premature, not waiting for 107. You look for something else. So you're flexible. Understand the broader market and indices. For swing trading, you have to understand the short-term market horizon for next 7 days, 10 days, where the market is headed. Is it to the upside or to the downside? So understand that. When you combine all this, then you're stacking the odds of success in your favor. So these are the broad points for swing trading. So now another point of the uniqueness of swing trading is a profitable trade comes before crowd notices. So that's the way the swing trading is. You're you see something on a day chart, and then you flip the lower level charts, like 1 hour chart, a 2 hour chart, or 30 minutes, and then you're noticing that it has already the stock has hit some level, and now it's about to make its move. The next move is either to the upside or to the downside. So profitable trade comes before the crowd notices. So you have a system or your skills to recognize that. And in swing trading, so we have to remember that in swing trading, the fortune is made via singles, not home runs. So singles comes in like 40% gain, 35% gain, 30% gain, 47% gain, these kind of gains. Sometimes you will have 100%, 200 is because you held on to the stock during the earning, or you got lucky. You were holding the position and the stock gapped up big, or the stock gapped down big, and you were long or you were short. So you have 100 or 200% gain. So that is you got lucky. It's not you're lucky when you are trading. You are so that is the when you're hitting the home run. It's a luck. It's not that you have a skill that you are getting 100 and 200% and the stock is gapping up. It's not a skill, it's luck. The skill is when you are constantly booking singles run. So single runs. So home run, you get lucky. Singles, you have a skill. So you're relying on your skills. Home run, from time to time, you get it. So what happened? The home run will take care of your failed trades. So you also have failed trades. So once in a while, you get 100, 200% gain, which takes care of your failed trade. But overall, the way you have designed your system, that if you know that the odd is in your favor, when even in the in the short run you have loser trades, that you have drawdown, but over the long run you will be the winner, and you're relying on single, not the home runs. So it comes occasionally, home run comes, but it's not like you put the trade and it jumps up and you get 100, 200%, unless you're trading a momo or you're very expert, where every time you put the trade and it goes 100, 200%. So if you're getting 100, 200%, then you may be losing 100% also. So it's smooth and rising. This is the objective of swing trading, that we need a smooth and rising equity curve. So now, in order to achieve this, so we talked about we talked about the market, we talked about the trading system, and we talked about the strategy. So all this is there, and we know what kind of what objective we have. Let's say we are swing trader. So now you have to know and to decide what trading candidates, what are the trading candidates, what kind of a market you will trade. And so you have to do this homework. This trading candidates, the stocks like Apple, Baba, Baidu, Amazon, Tesla, Home Depot, Lowe's, Caterpillar. So these stocks, Twilio, financials, Mastercard, Visa, PayPal, Square, these stocks. So you filter down based on certain criteria, such as volume, liquidity, spread, optionable, constantly have news or some catalyst. So you are further narrowing it down on in the market. So these stocks, I have certain lists. So I call it hardcore. So hardcore are those stocks which are like Apple, Baba, Baidu, etc. All these Momo big stocks, they move. And then I have the stocks which are called core. So let's say Home Depot and Lowe's, Caterpillar. So I put them in the core. So I watch these also. But the hardcore stocks, I call them like on a chess game. I call them kings and queens and knights and bishops and rooks. So different categories I've defined internally, but the broader category is core, hardcore, and then core, and then non-core are those stock like AT&T, Verizon. I just need to know where they are, because overall market, they are part of the overall market. So I need to know where they are, what they are doing. From time to time, I look at it. Then I have I divide further. So these three areas I divide further into the sectors, the industry groups, so such as airline, biotech, gold and silver, financial, oil, retail, tech, chips. So all these in a different category. So if certain, if oil stocks are moving, are they all moving in a rapid fashion to the upside, or they are moving in a rapid fashion to the downside? If one is slipped away, which one I can trade out of, let's say I have 20 stocks in oil, so which one out of 20 I can trade, because I know two or three they just moved away. Now the small cap stock, so is the market favoring the small cap? So if the market is not bullish, upward trending, then I wouldn't trade the small caps, because small cap stock, they just go down 20%, 25%, just like that. So I wouldn't trade the small caps, only very selected. And then when the market is bullish, then the small caps are rising, and they are just rising 40, 50, 100%. But you have to know, so whether the market is suitable for small cap. So think about that. Indices, ETF like DIA, QQQ, IWM, SPY, all these indices you need to monitor, and you need to maybe sometimes you get the proper entry and you trade those indices. ETFs, semiconductor ETFs, if the semiconductors are moving, then maybe you want to trade the ETF. Gold and silver ETF, if gold and silvers are moving, maybe you say, okay, no, I need to, instead of trading individual gold or silver stock, I just trade buy some ETF. Inverse ETF, if you have a trading system which is only and you are skilled at reading the charts on the upside, then you say, okay, I will only trade to the upside. So when the market is going down, you pull out your inverse ETF, and the ETF which goes up when the market goes down. So maybe you trade the market which is inversely correlated. So if the market goes down, a certain sector goes up. So you're only trading on the long side. So if that's your thing, then you trade only on the long side, and you select the symbols which relate to that kind of market. So now when we combine this, there is one circle which I'll put later is a trading candidate. So when you, but for now, think about this: is you and the market you're trading, the system you are expert at, and the strategy you're adopting. When you combine all this four, then your focus is very narrow, very laser focused, not narrow, but the laser focus. So now you reduce, um, and then so you reduce your laser focus on that kind of the symbols or the market which is suitable to you, to the kind of market we have, the kind of trading system you're using, and the strategy you're adopting. So think about that. And then, so based on this, then, and you're applying your symbols list. So now you are laser focused on this area. So think about it. If you don't do this, if you ignore the kind of market you have, if you don't know if what you're using fits this market, if you don't know that your trading strategy, mm, sometimes you're a day trader, sometimes you become a long-term trader, sometimes you become a stock trader, sometimes you're an option trader, sometimes you're trading the same stock, same stocks, option futures in the same account. You don't know how much you have invested in the stock, you don't know how much you have invested in option. It's a mess. So do you have a proper allocation, different accounts? What is your objective in trying the objective in that account? Some account may be speculative account where you are shooting for the moon. So if you're shooting for the moon, you don't mind, you want to make 1,000% to grow, you want to grow that portfolio 1,000%. But in order to achieve the 1,000% growth, you should be willing to be wiped out also. So 1,000% doesn't go without the risk of being wiped out. So if that is your thing, then go for 1000%. Maybe you are only 22, maybe you just allocated 25,000 and you say, okay, you know what, 25,000, I want to take it to 500,000. And in this process, if I wiped out, it's fine. So think about that. Whereas a person who is 60-year-old, he said, no, 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 I cannot afford to be wiped out. So I will trade very conservatively, and I will only trade when the market is conducive. So think about this. So you is what you're trying to achieve. So now laser focus on that. Now, another thing is about the dinosaurs. So when I was learning, and somebody explained to me that you need to trade when the big boys are there. So the big boys, based on the volume, the activity that the stock have. So you can call them the big boys, which move the market, create the wave, like dinosaurs. So dinosaurs can run but cannot hide their footprint. So think about those. The dinosaurs can run but cannot hide their footprint, so ability to detect these dinosaurs. So the the move is the stock is moving 3 to 7% because the dinosaurs are involved. Only me and you are not moving the market. So on the crowd is either crowd is moving the market, the crowd have the news, or the big boys are moving the market. So I mean, is nothing wrong with following the crowd. So there is something called the wisdom of crowd, but a lot of times the crowd may be wrong. So your beliefs and what you're trying to accomplish, if it matches what you are seeing based on the crowd action, maybe there's then you can execute the trade. So now, so after knowing all this, the U trading system and strategy, the candidate we are trading and all that, the kind of account we have. So now we talked about the 12 trading strategies or the 12 trading systems. So I will explain to you the features of these 12 systems. Now, these 12 systems, you can use multiple systems or multiple strategies at the same time. And then on top of that, you can apply the trading indicate the technical indicators, you can apply the volume on top of this. So you're applying the volume, you're applying the indicators, and you're applying your skill, judgment, and the experience you have developed, and maybe your intuition, maybe you're intuitive. And then the news is there, maybe you're reading the option market also correctly. So a lot of things you can figure it out from option market. So when you combine all that, you're stacking your odds towards your success. So I will explain to you these 12 strategies. So the first one is the black box. So the black box trading is somebody created some the big boys. They are using the black box, or the high frequency traders, or all these trillions of dollars moving. They are not reading the charts. Oh, this candle is looking like this, so I'm going to buy, or stock is hitting this support, I'm going to buy that. So maybe they are not trade, they have all automated, algorithmic. So they are reading the news, they're looking for the keywords, the spoken words. A person is talking, and he only said a and he is going to about to say and, which is a and d, and he just spoke and then it's so fast the black box react based on the sound he captured, that after a and d will come and analyze it, make the sense of the whole sentence, and the black box is start to trade. So you cannot compete with that black box. But the black box has to be like that. So the big boys have. So this all algorithmic and automated trading. They are entering and exiting in nanoseconds, or maybe they just keep buying because they're buying program triggers based on something happened. The formula, all the things that they have fed, and it triggers the buy program. And by the time you realize, they are already done buying millions of shares, or they are done selling. So think about that, executing trade without human intervention. They have a predefined criteria, complex mathematical models. So if it's raining in Brazil, what is the effect to the US market in that market? That's the kind of thing. Or somebody said something in Tokyo, and what it will be the effect in the US market. So they have a complex mathematical model. All the things they are they are not evaluating just let's see the Apple charts. It's going up. Okay, I'm going to buy. No, they have very complex mathematical models, complex, and they have all the historical data as far as they can go. If a symbol is trading, so all the historical data related to that symbol, the date IPO, and all the other related markets, all the volume data, all the news, they have everything. So their system is analyzing the historical data. They analyze the vast amounts of data. They have supercomputers. Whereas you trading, if you're trading on a little uh, phone and you open an account on a Robinhood, and you say, okay, I see this, and a spike, you heard something while you were driving, and your buddy called you and he said, you know what, the Apple is moving, let's buy Apple. And then you buy Apple, and then 30 minutes later, you see Apple tanking. So think about this. So this black box has the prices, volume, and all kinds of indicators, all kind of the models are there, and it's giving them the trading candidate. Now, you can there are $49 indicators. So think about that. If you're buying a $49 indicator because you heard somebody saying it's a master indicator, $49, and it spits out some arrow, um, down arrow or up arrow. So maybe that arrow gives out on what time interval and what kind of a market it traded when it was designed. So think about that. If you're this multi-million billions of dollars invested in the black box, or you're looking for that indicator which is $49. So the mechanics of black box trading is that a lot of data is collected, a lot of strategy is deployed, a lot of back testing is done in all kinds of market environment, all kinds of complex environment, all kinds of crashes in the past, and then the execution. So black box, this is the mechanics of black box trading. It's it has the advantage of black box is the speed and efficiency. There's no human intervention. The black box is executing the trades. There's no human. The human is watching, but is trading. There's no emotion. And because it is a black box, so scalability, so they have already defined so it can trade 100 shares and it can trade 10,000 shares at the same time, provided there is a liquidity in the market and it's not, you're not creating a wave. So scalability, so if you have a black box, if it works for most of the time, the black box will work. So there has to be some limit, because if you're trading more than, if it's only if it's working for 100 shares, it should work for 1,000 shares, provided there is enough liquidity in that market. But if you bought the black box and you are the only buyer over there, on average there are 100,000 shares trade, and your risk management system and or your greed saying, okay, let's go buy 5,000 shares because it's a $2 stock. So you say, okay, 5,000 shares, $2 stock. So you will create a limitation, even though the black box work, but um, you're not applying the proper formula to that market. But overall, the black box has the speed and efficiency, this emotion-free trading, scalability, and consistency. So it's straight, it doesn't lose. So over uh, maybe one day of a loss in the whole 252 trading days in the year, maybe one day it loses because it's highly proficient. So, but there is a limitations of black box trading. So data dependence, availability and quality of data. So the black box is relying on data. So everything is based on the data, the price, whatever they have fed, the price, volume, etc. So the quality of data, market condition. So there is a limitation of black box, if suddenly the market conditions change, maybe the human can react watching, but the black box may not react quickly. And if the black box is reacting, to the certain change in the market condition, it can go crazy and flash crash happens. So think about that. Systemic risk, widespread use of similar algorithms. So if everybody get hold of that indicator or the black box, then everybody is trading, then the edge is gone. So there is no edge because everybody is trading the same system, same algorithm. So the edge is gone. Now, there is another trading system or the trading strategy which you can use is a chart pattern. So the chart patterns, what are the chart patterns? So it's a visual representation of historical price movements. So that's what it is. The chart patterns are the visual representation. So the stock have a high, low, open and close. So high, open and low and close, and on a time interval, whether it's a 5 minute time interval or it's a 30 minute or 1 hour or day or weekly, monthly. At the end of the day, there is at the end of that finish, when the time interval is finished, it creates a bar. The bar, and then we give that bar a meaning. We give that bar a meaning, saying, okay, this bar looks bullish, and then combination of those bullish bars, we say, okay, this is a chart pattern. I think it's making a head and shoulder, or it is a double top, or it's a double bottom. So based on the bar, the collective candles or collective bars, we are analyzing on a certain time interval based on the historical price movement, which could be all things happen during the day. It's a visual representation, and then we give that visual representation a meaning. We apply our skills and we say, okay, this is a head and shoulder pattern. So based on what happened, we expect that this will happen. So valuable insights into potential future price trend. So based on what happened, analyzing the bar, let's say bunch of 15-minute bar over the 2 hour period, and then we say, okay, bunch of these 15-minute bar have created this chart pattern, so I expect this to happen. And then based on what I'm expect to happen, I say, okay, this is my entry point and this is my exit point. Then I go and I say, okay, I need to figure it out the support and the resistance. So all the, if I'm going long, so I say, okay, these are my resistance points and this is my entry point. So this is right now my entry point. Then I apply the stocking process, and I say, okay, I need to reduce my risk, and if I reduce the risk, I can increase my profit. I can buy more shares or more contracts. So I go about doing that, the whole process based on this chart pattern. So think about this. So it could be well-known chart pattern. So there's hundreds and hundreds of chart patterns. You can spend your life into learning the chart patterns. So the chart patterns are ascending and descending triangle, cup and handle, double top, triple top, multiple top, double bottom, triple bottom, multiple bottom, flags, head and shoulder, wedges. So you can start mastering all these chart patterns. When they form, what do you expect? Where is your entry? Where would be your exit? Where would be where would it would say that this is a failed trade? How many times it occurs? What is the frequency? What is the reliability? What is the potentials? All that, what time interval you should look at for these um, chart patterns. So think about this. So you're using this chart pattern, and then you can combine with other technical indicators, other value, other techniques and trading system, all the volume analysis, etc., the news, the options, etc. So uh, through chart patterns, maybe you are detecting the change in trends. So now you're also a trend trader. So think about this. I will explain to you the trend trading. So you're a trend trader, and now based on, so you trend trader, but you are looking, you're reading the chart pattern. So you're combining based on the chart pattern, you are identifying the trend. So the trend is what? When higher highs are made or lower lows are made, that is a trend. So over, and then when the trend is forming, then and the chart pattern is forming, so market is making a higher high or and a higher lows, and then certain chart pattern is also um, setting up. So maybe you like double bottom. So you say, okay, double bottom, I like double bottom chart pattern, and then the stock has made higher low, and it's going, if it crosses this price level, because it's as a resistance, I will, and it will hold the trend, I will go long. So now you're looking for the combination. You're looking for, you're saying chart pattern is double bottom. You're saying if I draw the trend line, it is holding, it's creating a double, is a higher or higher low. So you're putting that, then you're triggering your you're reading the support and resistance, and then you identify the support below, strong support, a certain level. So you say, okay, this is my support, so if it comes here, I will go long, or this is my stop, before below this is my stop level. You're reading the resistance, and then you're saying, okay, this is the resistance. So if the resistance is close by, I will not go long. I need to wait for the resistance to cross. So you are waiting for that resistance to cross so that you can enter in the trade. And maybe the resistance is a little far, so another resistance far, then you're putting your target based on the resistance which is way above. So you're reading, so you're combining the support and resistance analysis, chart patterns, you are using the trend analysis, and maybe you also use candlesticks. So now you look at the candlesticks, and it's the kind of candles are forming, the kind of bars are forming are bullish. So you say, okay, the bars are bullish, there is a trend, I can see there's a higher high, high lows. There is a strong support there. The resistance are so far. And then you say, okay, what else I left? Then you say, okay, I need to go and read the volume analysis. So you applying the volume analysis. So you master the volume analysis. And then you say, okay, the volume is picking up. The volume has a trend. Volume is confirming the validating my analysis. There's no anomaly in the volume. So this is the further confirmation. Then maybe you are a channel trader, so the channel is upward sloping. So you say, okay, channel is also upward sloping. This is another one. Then you go and read some news, and there are some positive news. So you say, okay, the news is positive. The market is also bullish. Then you also go into the option market, and then you read the option chain, and there are a lot of activity, a lot of volume, a lot of open interest. The spread is narrow. So when you combine all that's where you come up with the trade. So if you application chart, so confirm the trend signal is strength. Now the confirming the trend signal is strength is how many times that chart pattern. So you're identifying that you're reading the chart, and then you're applying the trend. So you're saying, okay, what is the strength? So the strength could be the test of the trend. So if the trend line is holding for 3 times or 4 times or 5 times, you you have certain criteria. Then you're saying, okay, this signal is a trend signal is strong because the volume is there and it has tested 5 times. So, and you're determining the precise profit target based on some previous turning point, based on some previous resistance level. You have identified the precise stop loss price based on the trend line break, based on the chart failing. So you have the chart pattern. You're saying, okay, this is a double bottom, and I expect this to hold. And if it fails, then this is my criteria for telling me that double bottom will fail. So that's your exit. So when you put all this 2 plus 2 together, you get 5. So now the limitation and risk of chart pattern. So think about this, the limitation. So what is chart pattern? So chart pattern is a bunch of candles, bunch of bars, and they create something like a drawing. So one day my son came up and said, "Hey, Daddy, I want let me draw something, and you tell me what it is." So he took his color pencil and a paper, and then he, zigzag, zigzag, he round, and then he drew something, and then he said, "Okay, Daddy, what is this?" So I said, "Oh, it looks like a dog." He said, "No, this is a cat." So, okay, next. So he drew again and then asked me, okay, what is it? I said, cat. He said, no, it's a dog. So for me, it may be a dog, and for you, it may look like a cat. So something up in the sky, the cloud, somebody is saying, something, and someone else is saying something. So it's all the beauty lies in the eyes of beholder. So what you are reading, I may not be reading it. So signal as good as your skill, you may be getting trapped in the false signal. So you may be getting trapped on a double bottom. So you're saying, okay, double bottom. And you may be reading the double bottom chart pattern on a wrong time interval. Maybe you forgot that the double bottom you're reading is on intraday chart, which is a 30-minute chart. So the 30-minute chart, the double bottom is formed, is just the market is reacting that way, and it's creating a double bottom, and you are seeing something which is not there because your bias is towards finding the double bottom. On the day chart, on the hourly chart, the market is already rolling down. So this double bottom is temporary. So instead of looking for, if you're looking there, instead of going short on that market because you are believing in a double bottom and you're looking at the short term interval on a 30-minute, you're going long. And then you see the crash because you forgot that the other higher time interval, higher time frame is to the downside. So the daily is falling, the hourly is falling. It's just the 30-minute. So 30-minute is just a pit stop. So you're reading it on a wrong time interval. You're bringing in your biases in the trade. So think about that. So again, you're bringing in your biases. So what is happening is you are the one who's bringing that biases. So that's why you factor plays a role in the market, and people don't understand. High subjectivity. So what is dog for me is a cat for you. So think about this. Beauty lies in the eyes of beholder. It could be just a noise. This chart pattern, so you have to understand what chart pattern on what time interval and whether it's reliable or not. What else is going on in the market? So it's just not just I see double top or double bottom and I go long or short. Now there is another trading is band trading. So think about the band trading. In band trading, they embrace volatility. So in band trading, you're capitalizing on a short-term price movement. So it could be for swing trading, it could be valid that you identify a band, a channel, lower line, upper line, and then you say, okay, you know what? When the market goes on a lower time line of the band, and other ducks are also in the row. So when the price reaches the lower line of the band and other ducks I have, they are also lined up. So when the other 5 ducks lined up and this stock comes on the lower price level and then a lower band, and then it reacts, and my 5 ducks are also in the row, I go long. So I go long. And then I close my trade when the stock reaches or that market reaches the upper line of the band. So the high line of the band, I say, okay, I close it. Maybe I have the strategy when it goes on the upper line, I go short. When it goes to the lower line, I go long. Or if it breaks the upper line, I go further long because now the band is expanding. Or when it drops below the lower line of the band, I go short. Or if the stock goes below the lower line of the band, and then when it comes and close above the lower line of the band, that's my signal that the market has come back in the band and I'm going long. So all this is going on in the band trading strategy. So you and the volatility also playing role. So there is a price range, the upper range and the lower range, and you're exploiting the market fluctuation. So the market is fluctuating between the lower line of the band and the upper line of the band. So that is your thing. If that is your thing, you master the band trading strategy, and then you look. Uh, so if you're trading, if this is your strategy, then you are looking, you have a basket of stocks. So out of 200 stocks, you're looking for those stocks which are trading in a narrow range. They're trading in a band, or the band has a width enough for you to capitalize a nice move. So, the size of the band. If the size of the band is narrow, then it's not good from the risk reward point of view. By the time you enter, the stock has already made its move. It's away from the lower line, and then you enter, and then by the time you're exiting, it has already gone to the upper line of the band, and then you're late in the exit. So there has to be some room for slippage because you will not be able to capture the whole distance of the band from the lower line to the upper line. So think about that. Are you skilled enough to capture the move in the band? So you can ride the bands of opportunity by setting, people have set the band of a 20-day moving average. Based on the 20-day moving average, they set the band. This could be a simple moving average, it could be an exponential moving average, it could be an adaptive moving average, it could be a weighted moving average. So there are so many kinds of moving average. So now you go and master all these moving averages: the simple moving average, exponential, adaptive, weighted, all that moving average. Maybe you tweak it, you say, no, 20, I'm not going for 20-day. I will set based on, let's say, 22 days. So you say, generally the market has 30 days. No, there's a 30-day in the calendar, 8 days for holidays, weekends. So there are 22 days left. So I will set 22. If that is your belief, then you set 22 days moving average. So again, you will inject your belief in the market. You will inject your belief that exponential moving average is better than simple moving average. So you're bringing your belief about the market. Think about that, and it's only you. So if you rely and you believe in it that this is a useful belief, then go for it. And so based on this moving average, you set the upper and lower price band, and then you execute your buy and sell order at the band price level. So the lower price level and the upper price level, you execute your buy and sell order. You can do that all day long. And then there are different kinds of band trading systems. So the Bollinger Band, based on the standard deviation. So now you learn about the standard deviation and you say, okay, I know about the standard deviation and I set the standard deviation based on this moving average, and I trade Bollinger Band. Or you say, no, I will trade Donchian channels, identifying highs, high and lows. Or you say Kettler channel, setting average true range. So then you learn about the average true range. What is average true range? How does it uh, how does it? You don't need to calculate average true range, but you need to know the mechanics of true range, how it's calculated. Once you understand the philosophy of average true range, and you use the Kettler channels, and if you master that, then it's fine. Use this and combine with other indicators and the volume and the news and the option, etc., or the support and resistance and the trends. So you can combine multiple systems, multiple strategies, multiple indicators and volume to trade the volatile market. So through band, you can trade, identify overbought and oversold conditions. So you say, okay, if when the market goes to the lower level, it's oversold. When the market goes to the upper band, it's overbought, and I will act accordingly. I will react to it. So band acts as dynamic support and resistance level, because the band is expanding and moving, expanding based on what is happening in the market. So there is a dynamic support and resistance. So when the band expands, it creates the lower line. If it's moving further down, then the support is moving down, and if it's expanding to the upside, is the resistance is expanding. So it's a dynamic support and resistance, where the static support and resistance is based on the past history, because the support and resistance based on the past history is just there. It's like a battlefield. A lot of traders bought and sold at a certain price range. Some traders died there and some traders survived, and that is your support and resistance, but it is a static. So if so and but when market is not static, it's constantly moving up and down. So when the market is moving up and down, it's creating this new support and resistance level. So we need to know those new support and resistance level. That's where we need to be flexible. We need to be flexible to understand these dynamic support and resistance, and then we act. So if we enter at 100 and then we identify a target at 107, and we are waiting for that 107 to hit, whereas the resistance has been created at 106. So if the resistance has been created at 106 and we are waiting for 107, though 107 was like 2 weeks ago, now it is a new resistance. It's 106. So get out before it even hit 106. So now the capturing the breakouts. So the band, when the market moves and it breaks out to the downside or to the upside, so price movement beyond the band, you can capture these breakout, because when the band is broken to the downside upside, is this a new territory. And stop loss bands are used as reference points. So you can apply the band, the lower level violation or the upper level violation as your stop level, depending on what kind of a position you have, long or short. But again, there is a limitation and risk. There is a limitation to everything. Otherwise, you can become a billionaire in a few months or a few years if everything is working. Not everything is working all the time, so there is a limitation. So false breakout. So the band may go, you may see the stock breaking below the lower level band, and then it comes back up, and it when it grows below the lower level, and you say, okay, my I'm going short, and you fail to analyze. I mean, market can do anything. So even though there's a strong support below and you did not read it, and the stock breaks the lower band and it's traveling below, and if there's no support, it's just going down, whereas you went long. So there's another problem. Whereas there may be static, strong support below the lower level band, and the stock breaks the lower price, and you went short and there is a support. And then what happened? The stock hits that support and reverses sharply and goes back to the band. It's like a chicken comes out of the cage and then it goes back in, and then you say, what? So there is always a limitation, and that's why we need to constantly apply the risk management. So adapting to market condition, adjust band parameter to suit changing market conditions. So see if you are using the proper parameters of setting that band, what you're using. And apply other techniques. Now, there's another trading system called trend trading system. So I already explained to you a little bit, and I'll explain more. So trend trading is riding the market momentum. So there is established trend, and you're riding that momentum. Sometimes what would happen in the trend, so when we say trend, there is a sustained price movement, and the price movement is in the direction of the prevailing trend. So whatever is the prevailing trend, the price is moving in that direction of the trend. So there's a sustained price movement. Sustained price movement means that the stock pulls back to some support. If the trend is to the upside, the stock pulls back towards the support, and then it rises upward again. So what would be your strategy? So based on the trend tradings, if you're trading based on the trend, then your trading strategy becomes, you say, okay, this is a higher high, high low, the trend is established, the trend is to the upside, the weekly is lined up to the upside, the day chart is there. Now I'm watching the hourly chart, and it's moving, coming down. So I'm waiting for this, so identify the support and resistance. So I think my strategy is to wait for that the stock to pulls back towards the support. It comes back to the support. Now it is doing its thing. So it's doing its thing at the support. Now I need to just don't jump on it. Then it reached the support. Now I need to go long. uh, the support you're reading is you are reading it. It's the market may not honor that support. So market may not honor the support. So the way we need to trade is wait for identify. If the trend is there, we know that, then it's waiting for the pullback patiently, and the market pulls back to the support, and then the market jumps. It will give you a secondary evidence. So you're looking for some kind of evidence. It's like a detective. You become a detective, like become a Columbo, and you say, okay, now I know this is the support, and now I become a Columbo and Perry Mason or something. I'm looking at some kind of evidence there that my belief that this is so I'm bringing my belief now in the market. So my belief is this is a upward trend. The pullback is just a pullback. It's a temporary pullback. It's a dip. It's not a correction. So I'm bringing another belief in it that this is not a correction. This is a pullback. So I'm bringing now in the pullback. I'm saying to me myself that I will buy the dip. So then I say, okay, I buy the dip. I wait patiently. So I bring my mental state to wait patiently. So based on my belief, I am um, seeking the adopting the mental state of being patient. So being patient is triggering a process, mental strategy. So what is the mental strategy? A process is triggered, and the process has certain steps. So I need to adopt those, the certain steps. So I'm bringing a belief that this market is trending. The belief triggers mental state of being patient. That mental, that patience process is triggering a mental strategy, which is follow the process of stocking, bring the market down. Once the market comes to the support level, now I am looking for secondary some evidence to sustain my belief. So that evidence may come, the stock moves up, and then I'm confirming further with some kind of a volume or some kind of a reaction. So once I have all that, then I lined up my execute my buy trade. So that's one thing. Now another is the sometimes, most of the time, what is happening, the traders, we have a tendency to trade the trend which is already established, and it's too late in the trend. The trend has been already been established, because the higher highs and the higher lows are being made. You cannot make a higher lows after a stock moves a certain distance. Only then you can say, okay, this is a higher high and higher low. So maybe for swing trading, that trend is too late. So we need to work on more on for swing trading. For swing trading, maybe you have a process of detecting the change in the trend. So the change in the trend is coming. So the market is moving down, and now it's doing something which is telling you the change, the downward change, the trend is now about over, and the market will make a upward move. So you if you have that belief and you have expertise, then you're detecting the change in the trend, and then you have a certain strategy to line up your all your ducks in the row, and then you get in. So that's one thing. Now, the types of trend trading system. The trend trading system, moving averages. So you can use moving averages to identify the trends. Moving average could be 20-day moving average. Every time the stock, it touches the 20-day moving average, it bounce up. It has done 3 times before, so it will do the 4th time also. So you're waiting for that stock to pull back to the moving average, and that's your entry. And exit is some other criteria. Trend line. You can draw the trend lines. So you take the recent low, maybe you're looking at the recent low, swing low, and then you draw take the lowest low, recent lowest low, and you start drawing all the way to the upside, and then you say, okay, this is a trend line. So different traders will draw the different trend lines. So let's say you draw the trend line to visualize the direction of price movement. You can take help from the Fibonacci fan line. So based on the Fibonacci ratios, percentages and ratios, you can draw the Fibonacci fan line. So if you believe in the Fibonacci numbers, you can use Fibonacci ratios to draw the trend line. There's another technique called parabolic SAR, trailing stop and reverse indicator. So this is in the fast the system. So based on the trailing stops, you can, maybe the stock has reversed and now it's moving up. So based on the parabolic SAR, which is available in most of the chart system, maybe you can use parabolic SAR to develop your trading system. So think about that. There are various ways of analyzing and adopting the executing the trend trading system. Now, application of trend identification. So identify uptrend and downtrend. So you need to identify again on the time interval. What if something, the trend may be upward on the day chart, but the trend may be downward on the short-term chart. So all chart needs to be aligned. So think about that. Which one you are believing in? Are you believing in the higher time frame, or are you believing in the lower time frame? You believe that the lower time frame will change the trend in the higher trend, or you believing that the higher time frame is to the upside, so the lower time frame is just a normal pullback and it will reverse to the upside. So you're looking for a pullback. Entries and exits, trend line breach. So maybe you drew the trend line and then you say, okay, if the trend line breaches, I would exit. My trade is no longer valid. Or maybe you're looking for some moving average crossover. When the moving average crosses one, crosses the other side, I will exit. Trailing stop to protect the profit, stay in the trend. So once the trend is there and you are in the trade, then you are lucky. So now you're lucky and you got the you are in the trade, so you're riding the trend. So there has to be some kind of, after the trade moves in certain direction, then there has to be certain kind of a trailing stop to protect your profit. So you know, okay, this I have, no matter what, I'm trailing it, and if my stop loss hit, it hits, but I will capture this move to protect the profit. And if the market is moving to the upside, let's say you to the upside, your trailing stop is moving to the upside, so you're capturing the trend, and if it reverses, then you are out to protect the profit. So your stop loss is moving upward as the stock is moving upward. So that is the trailing stop. So limitation and risk management. So false signals, you can get the false signals. What you're drawing the trend may not be the trend line. So think about it, it's all subjective. When you're drawing the trend line, when you're reading the trend line, it could be subjective. It may not be there and you're seeing it. So when the market is sideways or choppy, the trend lines may not hold. So the trend line hold, when the overall market is bullish and you're looking on the bullish side, the trend is there and the dip is there, and then it bounces upward. So that kind of a market gives you proper signals. In a choppy market, trend there is no trend. Whipsawing, sudden market reversal, frequent trade exit. The stock goes up and down. So timely exit, identifying trend reversal promptly. So in trend trading, if the trend is broken, so you have to acknowledge that the trend is broken, because you were trading based on the trend and the trend is broken. So when the trend is broken, you have no reason to stay in that trade. You have to exit, because that was your criteria and that criteria no longer holds. So you need to exit. Now, the trend trading, you can take help with the chart patterns. You can take help with the candlestick. You can take help from the volume. If the trend is broken, let's think about it. If the trend is broken and there's no volume, then you have some leeway to hold your trade, because the trend was broken, but there's no volume. So then you can apply a different criteria for your exit. You say, okay, the trend is broken. I know its trend is broken. The trend line I drew, the stock is on the other side, but the volume is low. So if the volume is low, it's good for me because I'm long. Now you're waiting for the stock to reverse back up and goes on the other side of the trend. So then you can apply a certain criteria, other criteria for your exit. Then you say, okay, I can apply the number of days the stock has on the other side of the trend. I can also apply the dollar amount it is trading below the trend line, or the percentage of the stock. So the dollar amount, the percentage, the number of days passed, the volume. So you can combine all this to understand if you are exiting, if you need to hold, or you need to exit. If the stock is crashing down with the volume and it's broke the trend, then you need to, maybe you exit. Maybe you missed it and all the selling is gone, and it's now it's time for the stock to reverse. So think about this. So any trading strategy or trading system you're using, then you have to ask the questions. Only you know the answer to these questions, which I have put 9 questions on the screen, and it's applicable to all the trading system, all the trading strategy you're doing, because is you only you know the answer. So if we apply these 9 questions to trend trading, then see what's the answer. So do you believe in trend? So ask yourself, do I believe in trend? If you don't believe in trend, then you shouldn't be trading in trend. But if you believe in trend, then trade the trend. Does trend trading fit my trading style? Maybe you have a different trading style and it doesn't fit your trend trading doesn't fit you. So if it doesn't fit your trading style, then don't do the trend trading. Then you can ask another question: what strategy I need to adopt to enter in the direction of the trend? So you believe in trend trading system, but then you have a strategy or not? The strategy could be, I believe in the trend. I'm not a contrarian trader. I trade in the direction of the trend. So I believe I'm bringing my belief again in the market, that my belief is that I need to trade in the direction of the trend. And my belief is that I need to look at the higher time interval for the trend. So if I'm bringing that belief, then I will bring in the strategy which is suitable to my belief about the trend trading. Now, when I'm adopting the strategy, then I also need to know what would be my initial stop in case trend changes. So what will tell you that the trend has changed? So what you will see, or what you will feel, or what you will hear. So will you hear, or you see, or you will feel what is going on over there, that you say, okay, you know what, my this trade is wrong, and this is where my initial stop, and I'm exiting. Now, another question you need to ask, what would be my profit taking strategy? So you get in the trend, now where you will exit. So how you would exit? Will you exit on trailing stops? Will you exit based on some resistance level? Will you exit based on some turning points? Will you exit based on your profit objective? Are you trading stock? So you have a profit objective of 7%. Are you trading options? So it's 40%. Are you combining number of days you are in the position? So you have been in the position for 10 days and you're trading a stock, so there's no time decay, so you're waiting for the stock to hit. But if you're trading option, the time decay kicking in. So all that is going on for your profit taking strategy. So what is your profit taking strategy? Again, you need to ask another question: what would be my position sizing strategy? How much I need to put in the position? So ask yourself, only you know the answer. Only you know your portfolio size. Only you know your age. You know your profit objective. You know your risk profile. So only you know what is going on in your life and what you're trying to accomplish. So all that questions come up, and the answer comes how much you're going to put in that trade. So think about that. Once I exit from the trade, how will I get back in if the trend resumes? So if you read the trend and it's moving up and you were fine, and then suddenly it changes and it goes back down and you exit, so there's again you exited because you're fearful. So again the U factor is playing role. So U factor is playing role, and you exited from the trade, and now the trade comes back in to the same direction you were in before. Now you're regretting. So you're regretting. Will you just regret and stay on the sideline? So again, you are bringing you're seeing the trade moving, but you're staying on the sideline because you exited. So if but you say no, I need to enter in the trade. So what is your strategy? What would you see that you need to get back in? So think about that. Also, once you're in the trend, so let's say you're the trend, and getting into the trend is highly profitable, and traders make fortune. And the way they make fortune is through scaling in strategy. They make fortune on scaling in. So they combine the trend trading with the scaling in strategy. So what is the scaling in strategy? When would you scale in? So what will tell you that it's time to add more to the position? um, is it the momentum? Is it the number of times the stock has moved day after day? Or are you basing your scaling in by raising your stop loss to the upside? Are you scaling in based on the new support is formed? So you're reading some dynamic support. So the market creates a static support, and then there is a dynamic support. So when it creates a dynamic support, then you say, okay, I bought 100 shares, now I can add another 50 shares because I know this is a new support, and I will exit if this new support is violated, or I will exit when the trailing stop is violated. So what is your scaling in strategy? How long you will go in and keep buying and scaling in? So do you have a strategy? What will be your scaling out strategy? Once you scale in and you pile up in the trade, and it's traders make mistake because the greed comes in, including myself. So I'm telling you everything what I am facing and I face every day. So greed comes in, I scaled in, I see $7,000 profit, and now I'm not scaling out. So I'm not scaling out because greed is setting in, and I'm expecting the 7,000 will go to 14,000. It goes to $4,000. So what is my scaling out strategy? How will I exit? Because when I'm scaling in, I'm increasing my exposure to the market, into that individual market. So my position is tilting. Some percentage of my total portfolio is increasing towards that one symbol, because I scale in. So when I scale in, I'm increasing my portfolio. I'm supposed to only risk, I'm supposed to only invest, let's say, 4% of my total portfolio in that trade. And because I scaled in, I am now 10% of the portfolio. So that's a big, and I'm seeing a big profit on the other side. So it's fine. I'm only looking at the big profit. Oh, look at me. So much profit piled up. And the reason I piled up so much is the stock has moved, but I also scaled in. And so I kept buying, and every thing I see and I buy. So that one position is the one which is bringing a lot of profit. And if that position goes against me, then I will be in a big trouble. So I need to remind myself that I need to start scaling out. So what is my scaling out strategy? Is it a certain resistance level I will exit, or is it a certain exposure level I will have that I need to worry about and start scaling? Is it the dollar amount of profit I see that I need to scale out? So what is going on? So ask yourself these questions and work on it. It doesn't matter if it's a trend trading system or a band trading system. Now, there's another trading system based on support and resistance. So support and resistance system is identifying the key price level. So if the key price level is based on the historical price where the battle had been fought, there are psychological barriers. We need to understand that there are these psychological barriers. There are three market participants which have created these barriers. So who are these three market participants? So you have to dig deep and maybe lay down in bed and think about it. Who are the three market participants and how they come? So anytime when there's a complex thing, I just go in, become a monk for a few minutes till I come up with clear, understanding. So the three market participants are the buyers, those traders who are long, those traders who are short, and then there are those who they are neutral, they don't have any position. So these three create the the support and resistance. So understanding the psychology of these participants is crucial. These three participants create the support and resistance level, and how they create. I have another presentation on this, and I explain in more detail. Anyway, so mastering the support and resistance, your key to trading success. So this is very important to understand the support and resistance. If you understand support and resistance level, let's say you master it, and you master this volume analysis, and then you master the trend trading. So you master trend trading, you master support and resistance, and you master the volume analysis. When you combine these three, it will bring you success. So think about that. Mastering support and resistance, your key to trading. Support level, buying interest is strong enough that prevent further price decline. So that's what support is created based on the previous price battle, and now at the same price level, there's a buying interest, there's a demand. So you create a demand, and then you understand, and there's another demand coming up, same price, another demand showing up. So that's creates a support. Resistance level, the resistance level is the selling pressure. So selling pressure prevents further rise. So that's what happened. There is a supply. Trader wants to get out from this level. At this level, they are trapped. So they are trapped because they bought, and they are holding it for a long time, and now they want to get out. So that's what it is. The selling pressure is there. So support and resistance is the collective actions of the market participants, and the market participants are who? The buyers, the sellers, and non-committed traders and investors. So the support and resistance is being created by these three people. The another For support and for swing trading, the you have to, and also as you trading, we need to understand the swing highs and lows, where the swing highs are forming, where the lows are forming. another psychological level, the round numbers, the 100, 200, 500, 1000, 2500, 5000. These round number play some kind of a psychological level. So if the stock is approaching from below 100 and is approaching 100, that it creates a resistance. If the stock is coming down towards 200, it's act as a support. So Tesla did that recently, and I went long on Tesla. We made a lot of money, but just simple follow that the 200. So it broke the 200 and it bounced up, and then there was a buying, and then I went long and I bought options. So I combined the psychological levels, and I saw that move and simply went long. So think about that. It's a caveman trading. Moving averages. So these moving averages play some kind of a role in the support and resistance. 20-day, 50-day, 200-day moving average, 10-day exponential moving average. So pay attention to moving average, psychological level, these round numbers, and the swing highs and lows, and all the actions. So support and resistance, I have a detailed another presentation. I'll teach you some other time. So based on the support and resistance, it creates entries and exit points. So think about that. It creates entry and exit point. It gives you the stop level, and you also can gauge the market sentiment. So you can also gauge the market sentiment based on the support and resistance level. So think about this. I will. So this I'm showing you the chart, and it's very detailed. Like, I will not go into detail, but I'm just give you, because of the time I'm talking for so long. So I will teach you this chart again in some other session. I'm just showing you that this is a market. When the market moves, it creates certain resistance, then pulls back, then it goes up, creates a resistance, then pulls back, then goes up. So this is the support and resistance. This is all day long going on. But in the other session, I will explain to you in detail the phenomena, what you're seeing right now in front of you. Now, on the other side, if you flip it, then it creates the other side. So the market is coming back, it reacts, and it creates some kind of a support. And then it moves up. Just my throat is, so it moves up a temporary rally, and then it just tank. So it tank on the way, it will stop somewhere here a little bit, and then it just keeps going down. And previous, based on some Fibonacci level, some based on the previous market reactions, or whatever is the reason. Maybe there's some news. So whatever happened, there is a support here, and we come to know about the support when the market moves up. That's where we come to know, oh, this was the support, and the market moves up. But on the way up, the market will can meet this resistance, which was here, because there are a lot of buyers who bought here at 1, and they saw the rise here to 2, and then when it pulls back, they did not get out. So they are all holding their position. So when it goes back to the price, the same price, provided they did not average down, they are exiting here. So this is a double, you can say this is a double top. So here's one top and here's another top, and the market crash. So market did not hold and market crash. So there's a lot of analysis behind. I will explain to you in some other session. So limitations and risk management, false breakout. So if we are relying on the support and resistance, it's good to know about the strong support and a strong resistance, and there has to be some criteria for saying that this is a strong support or this is a strong resistance. But it could be a false breakout. Sometimes the stock just move above the support and tank, and it can, I mean, it comes to the support and then it bounces and then it tanks, or it goes break the resistance and then a little bit move up and then it tanks. So a lot of things, false breakout can happen. So frequent breaches. So in support and resistance, you need to apply multiple time frame and evaluate support and resistance at several time frame. So think about that. Then applying the using the multiple time frame. Do you have a process of evaluating your trade on a multiple time frame? So, so that is the support and resistance, and it's an area on its own. Now, there's another trading system, which is a breakout trading system. So breakout trading system could be when the price breach the key support level. So when the price break the key support level, is a breakdown of that stock, and you enter short, and your exit from with the loss will be when if it comes back to the same price zone, because your reason no longer holds. And on the upper side is the price breach key resistance level, so you go long. So there's a potential trend reversals also can occur, which is means that the stock has crossed some resistance level. So when the stock crosses some resistance level, it's a continuation of the trend. So the trend, the stock hits the resistance, pulls back a little bit, and then it breaks the resistance to the upside. So it's a continuation of trend. Or the stock hits the resistance level and now it's tanking. So the previously the stock was moving up, that market was moving up, so the trend was to the upside, but then it hit some resistance and it is tanking, so it's creating a trend reversal. So and the same for the other side. The stock is going down, so the trend is to the downside, and then it hits some strong support or something happens, some catalyst, some sentiment change, and the stock is reversing to the upside. So the trend reversal is occurring. So breakout, that's breakout trend trading. So you're identifying that either the trend reversal is there and the breakout is happening. Some nearby resistance is also being broken, or some nearby support is also being broken. So what is the types of breakout system in strategy? The breakout above resistance, it's a continuation of a bullish trend. So if there is a trend there and then the stock hits the resistance, it stays there and then it breaks above the resistance. So the cannonball is fired, and the cannonball is fired and the big resistance is broken. So it's a continuation of a bullish trend. If the breakout is below support, then it's a continuation of a bearish trend. So the trend was to the downside and the support comes and the stock holding the support and then it breaks further. So it's a continuation of a bearish trend. And the breakout retest, wait for a retest, then enter in the position. So when and one of the strategy is when the stock breaks the support, so we know it broke the support and is going down. So we say, okay, the stock broke the support and the stock is moving to the downside. It broke the support. So you don't react to the immediate break of the support. So you wait for the retest. So you wait for the stock to come back one more time from below to the support level, and then you go short. So breakout retest, wait for a retest and then enter the position. Application in trend reversal. So capture trend reversals opportunities for yeah uh, capture trend reversal. So in the breakouts, the capture trend reversal opportunities for profit. So if the stock is, so this has to be a fast and a quick move. So when the stock is, let's say the stock is coming down to the support and the trend is to the downside and it comes to the support and it broke the support. If it broke the support and then it comes back above the support, so when it's coming back above the support, you're applying a different strategies. Maybe you're looking at the intraday reversal, maybe you're applying the volume, maybe you're seeing there's a positive news there. So the trend reverse, the trend broke the stock broke the support and then now it's moving up fast. So you are combining the intraday reversal techniques into the breakdown of the stock. So you're going the opposite sides. You're not reacting for the stock. When the stock break the support, you're not reacting on that, rather you are reacting on the other side, and you may be reacting on the confirmed breakouts. So if the breakout could be on the other side or breakout on the other to the downside. So if that is your strategy, then you apply the volume and other indicators for the strength testing. So the stock may be breaking down the support, but if there is no volume, then you say, okay, there's no volume and the support is being broken. So if the support is being broken and there's no volume, then you don't want to go short on that trade because there's no volume and the stock will just stop going down and will reverse to the upside. So now you put that stock on your watch list to go long, and you're looking for the stock to make a move. especially if it broke the support and now came back above the support. So now you're waiting for it to give you some kind of a confirmation that the stock is reversing to the upside. You may apply other indicators to do the strength testing. Now, to set the price targets, measure the height of the breakout. So if the stock made a move, let's say the stock making a move after pulling back, and is reaching, is crossing the resistance. If it's crossing the resistance and the stock has not made its move before in that territory, so how you determine the target? You determine the target by measuring the previous swing highs and swing lows, and you then apply that height, the move distance, to the new, from the new breakout price level, that you say, okay, previously it traveled 5 points. Now I expect, because it broke the resistance, so now I expect another 5 points move to the upside. So now again, there is a limitation in risk management. So false breakouts, false signals. So in the stock may break the support, or break the resistance, and then it does the other thing. So there could be a false breakout. So this is not 100% proof that, okay, the stock broken on the other side, then it's going down. No, it can go on the other side. So you may missed out, you may be missing out the previous support level. You may be missing out the reading the higher level chart. So on a weekly chart, if you flip your chart on a weekly time frame, maybe you see there is a support there. On a daily chart, it's looking like it's going down, but on a weekly chart there is a support, and you miss reading the weekly chart. So when you miss reading the weekly chart, you enter short based on a daily chart, but and then you say, okay, what happened now? Why the stock is, I see the clear breakout, but then you fail to read the support at the weekly chart level. So pay attention to the higher time frame to have a clear signal. So you can have a whipsaw, sudden reversal after breakout, frequent exit. Volatility management, consider volatility of the underlying. So if you're trading Tesla, if it breaks a support, or if it breaks a resistance, it may go a certain distance before it does the other side. So maybe in that kind of a Momo stock, you may profit, but you have to adjust your position size accordingly, because when if you're trading Tesla and if it goes the other way around, you may incur a heavy loss. Your portfolio may not be dictating for you to trade Tesla, because it's volatile, the options are expensive, and it moves the one way or the other. And there are some other stocks, there are a lot of stocks which move up and down, and we are not supposed to trade, because two things. We first of all, our portfolio is not aligned. Secondly, we are mentally not ready to trade those stocks, and the time, etc. So just avoid, if everything not fits your criteria, because people trade these stocks based on the greed, and they are not ready for it. So breakdown trading strategy, profiting from trend reversal. So prices break key support levels, and you're capitalizing on bearish trend reversal. So think about that. Types of breakdown strategies. Breakdown below support. So we talked about the breakdown below support, so expecting bearish continuation. Breakdown retest, so wait for a retest. Maybe your strategy is wait for the breakdown retest, so the stock breaks the support and then it goes up, test the support, because that support turns into resistance. There is a polarity principle, and the polarity principle is telling you what was what was previously a support. Once it's broken, it becomes a resistance. What is previously was a resistance, when it's broken to the upside, it is a support. So that is a polarity principle. Now if you remind yourself that this is a polarity principle, I need to wait for the retest. So if the stock broke the support, you don't go short on that support. So you may be saying yourself like this, okay, I see the stock breaking the support. Now I wonder, what the if I'm going short, so all the ducks are in the row or not? Am I looking at the higher time frame or not? Am I understanding the volume on what the other guy is thinking? The guy who is sitting, I'm sitting in San Diego, what about the guy in the New York, or what about the guy in Timbuktu, what he is thinking? So I need to be suspicious. I need to be vigilant because the other guy is thinking, okay, this is a time to go long and I'm going short. So if it would be nice if I see the retest and then I see another evidence of stock tanking. That's where my my entry will be nicer because I'm entering just near the support level, near the resistance level. So if I'm going short near the resistance level, if the stock goes up, I'm out. So I will incur a less loss compared to if I'm not waiting for the retest and I'm going short. Now, the stock can break down and have a momentum. So the stock can break down and have a momentum. So there's a lot of volume and everything is just tanking. So if that is the case, the stock is making a new low, weekly low. It may be making a new 3-month low, and the volume is huge and it's just tanking. And there's a lot of volume in the options and everything is there lined up. So that could give you a lot of profit if you, especially if you're trading options. So application in trend reversal. So capture bearish reversal, expecting, I think this is a maybe a duplication, expecting bearish and set price targets. So I think this is a duplicate slide. So limitation risk management, false breakdown. So now there could be a false breakdown. So I explained to you already the sharp reversal to upside. So the stock, a lot of time the stock break down below the support and then sharply move to the upside. So if you're looking on a breakdown of a stock on a daily time frame, so think about this. I'm looking at the stock at the daily time frame and it's breaking down. Now I go on a weekly time frame and I see, is there a support? If I identify a support and it's far, so I calculate that the on a weekly time frame the support is far, the stock is moving down on a daily time frame. So because I know the weekly, based on the weekly time frame, the support is far, so I calculate how much meat the stock has, and during in that, the reward I have, I need to apply some kind of a slippage because I will not exit right at the support level. There will be a slippage. So let's say there is a 10-point move. There's a 10-point difference from my entry. I'm entering when the stock is tanking, and on a weekly chart, the support is 10 point away. So let's say I calculate I'm entering a short at 110, and on a weekly time frame, the support is at 100. So now there is a 10-point move, but that 10-point move, I will not be able to catch the 10-point move. What if the stock goes to 102 and then it reverses to the upside? What if it goes to 102.50 or 101.50? So there has to be some cushion there because I will not be able to catch. So, and if I don't, if the weekly time frame is saying that the support is 107 and I'm going short at 110 on a daily time frame. So think about that. Now there is only a 3-point difference left. So if I'm an expert, maybe I'm a day trader, I capture that 3-point move. But think about how much risk I'm taking, because if the support is 107, what if they come and start buying at 108 and I'm going short at 110? So there was a 3-point cushion left, reward, and they come in before. So now I'm caught. So sharp reversal to upside because they and and the 107 is the weekly chart support. What if the news comes in at 108.50? So there's a news comes in and there's 107 support, long-term support, then the stock will just start rising sharply. So pay attention to all that. Confirmation indicator, use volume and other indicators. Market volatility, consider market volatility. I think this is a duplicate slide. Now there's another trading system called gap trading. So in the gap trading, so again, you can apply the gap trading with the trend trading system with the support and resistance system. So you can combine all that. So gap trading is you're exploiting the price gap. So whenever there is a price discontinuity, it's called gap. So the price discontinuity is between the close price of yesterday and the open price of today. So out of 9,000 stocks, most of the stocks are gapping up or gapping down, but it has to be some meaningful gap. So define your meaningful gap certain criteria, such as percentage gap or dollar amount gap. So if you apply the dollar amount gap, I apply the percentage gap and other criteria. So for instance, if the stock is a $200 stock and it gaps up 2 points, it's what, 1%. So that's not a meaningful gap. But if the stock is trading at 50 and it gaps 2 points, so that is a different gap. So think about that, what you're when you're evaluating the gap, what you're looking at, and the gaps are clear. Once the market gaps up, it gaps up on a day chart. So that is there. Now you quickly evaluate where is the support, where is the resistance, etc. What is the volume? But your real trading comes in when you flip your chart on a lower level time frame, and there's the landscape. You see the landscape, all the, and then you will know on a 30-minute time interval where the market closed, where is the gap, and how much gap is there, and what is the potential, whether the stock will pull back or continue higher. So you have to decide at that time. Markets open higher or lower, so that is a gap. So gap creates a unique trading opportunities. So, but gap trading requires a certain level of expertise. So if you're not, don't trade gap. So gap up trading, gap down trading, gap reversal trading. So you can trade in the direction of the gap up, you can trade in the direction of gap down, or you trade, if you think I need to go short when the stock gaps up, you're going against the trend. You go long when the stock gaps down, you're going against the trend. So think about that, how many times you're successful in a gap reversal trading, and what kind of techniques you're applying, how are you reading the support and resistance, what else is market is telling you about the gap. So gap trading, there is a price discontinuities. You capture the quick profits in the gap and identify the market sentiment, so potential trend change. So gap, when there is a gap, it means the sentiment has changed. So certain thing is happening. That's why the market is gapping up. So, and how you would identify the stop levels beyond the gap to manage risk. So the gap trading, it has its own session. So I teach in detail gap trading. So we just going overview. So gap fills, not all gaps continue. So the stocks gap up and then they gap fill, or gap down and they fill. So when they fill, you need to understand, is it where you would enter? Is it, are you considering the gap fill as a support, or you feeling, saying, okay, the gap fill is a resistance? So what you are looking at the gap fill, where you are setting your entry. So whether at the open of the gap, whether at the midpoint of the gap range, or you're looking for the previous candle high or close. So what you're looking at, and what kind of a gap? There's a gap. There's something called lap up gap, and there's so many gaps. So I explain in a different sessions. Window open. So gap is like window open and window close. So think about that, window open and window close. Timely execution. So timely execution of the gap, you have to apply another technique called opening range breakout, where the stock gaps up, and then you're waiting for the certain time and you note down the high and the low, and then you're applying the high and the low to a certain time interval. So certain time interval, let's say 30, you say, okay, this is, you're looking at the stock in a 15-minute pass, and then you say, okay, it made this high. So you set the high alert, and you say, okay, 15-minute pass at 6:45 a.m. If the stock makes a high after gapping up, then it merits my criteria. Then I will set that a new high, and then I will wait for the 30-minute time interval to pass. When the stock makes a new high at 30-minute time interval, where all the news are coming, that's where I say, okay, now I know this gap is a meaningful gap and all the volume is there. The option, if I'm trading options, all the option data is lined up. So this is the gap I am trading. So what I'm doing, I'm applying the gap and applying the opening range breakout. I'm applying the support and resistance. I'm applying the volume. I'm reading the news. I'm going in the option chain. I'm combining all that and figuring out if there is a potential there. I'm looking at the weekly chart. If the stock gaps up and on a weekly chart there is a resistance, I shouldn't be trading that and going long on that stock, because there is a resistance on a weekly chart. If the stock gaps down and it's reaching the support based on the weekly, I shouldn't be trading short on that week on the gap, because there is a support. I'll be losing tomorrow. So think about this. So there is a specialized techniques, and you can focus on capturing price movement, reversal of initial move. So if you're trading the gap reversal, maybe you can read the gap reversal. Maybe the gap is occurring in gap up is occurring in a bearish market. So maybe you say, okay, the market overall is bearish, and this gap up, I will rather trade the shorts. Or maybe it's a bullish market and the stock gaps down, and the beauty lies in the eye of the beholder. There will be traders or investors, they will come, they will recognize this is a fair value, and this is a 200-day moving average, this is 250-day moving average, and they will buy this gap down. So think about this, that you don't get caught in the gap. So types of gap reversal. So gap up reversal trading, so selling short, so you go short on the gap up. Gap down reversal, you go long when the stock goes down, so you go bullish. Gap fill trading, so gap fill, the stock gaps up and then you're waiting for the gap to be filled. Like we traded recently Microsoft. So Microsoft gapped up. um, so Microsoft gapped up, and then it starts to, so we were already in a long position in the Microsoft, and it gapped up big. So when it gapped up big, we were already there, we closed the position. Now, the position you close, maybe that's, if you are long in that position and the stock gaps up, so look at that. Don't ignore it. So maybe it's giving you, in few hours, it will give you the signal to go short, put the position on the other side. So Microsoft gapped up, you close the position, you're already there, we close the long position, and now it's reversing. So it's reversing. So it becomes very crucial. So it's reversing sharply. And then now you're saying, okay, should I wait for tomorrow to see what it does? Should I go short intraday? So all this, so many bullets are flying and things look hazy. So now you go on an intraday level chart, you go on a weekly chart. So I go on a weekly chart, I'm looking at the intraday, I'm looking at the volume, and now I'm making my decision to go buy puts, because I'm seeing the high of the day is the high, and the Microsoft has gapped up big. So what are my odds that the Microsoft is reversing sharply after gapping up, that it will uh, move up and make a new high? So I go and buy puts. I send the alert, and next day it just starts to move down, 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 down. Now I'm looking for, will it come down to fill the gap? But if the gap, if there's a big distance in the gap, so I would may wait for a few months for that gap to fill, because I'm a swing trader and I bought the option and my option is already up 80% next day. I am not waiting for the gap to be filled. If it's partially comes in between, I, I'm closing it, because I made yesterday on the long side. Now I'm making it on the short side. So I need to close my put position quickly. So you see, different traders will react differently. Maybe the gap up and the pullback, they will think, okay, I need to go long, and they did not go short. Whereas another trader is closing his long position and going short. So application in identifying trend changes. So gap up and gap down, most of the time it tells you the sentiment has changed, and then the reversal is there. So you create, also apply when the market is gapping up. You need to see if there is a volume confirming the move in the gap, and what other actions are happening, and set the price target, measure the height of the gap where it all began. So look at the look at the price. If the stock gaps up from 100 to 100 and let's say 5, so it gapped up 105. So $5 move, and now it's trading at 107. So calculate that it gapped up 5 points from 100 to 105. So from 105, it will go to 110. So So if you know that it's going to 110 and it's trading at 107, so now you have 3 points. But if it's already at 110 and 111, so it has done its move. So that kind of a gap, you don't want to trade because you're going in an overbought level. So you need to ignore that gap. The odds are not in your favor. So again, limitation and risk management. There's false reversals. The stock gaps up and you go long and then it reverses on you. Market volatility. Consider the market volatility. Timely execution. Trader must act quickly. So on a gap trading, you need to be very quick and sharp in deciding whether to go long or short, and whether you need to wait and time your entry. Now, there is another trading system called intraday reversal trading. So, intraday reversal occur during intraday level. It could be that the stock has nothing to do on its downfall. Let's say the stock is going down and it's just going down because of the something there in the market. And now there is a positive news comes. So when the positive news comes, the stock, not only all the market starts to move up, but that stock is reversing sharply because there was nothing wrong with that stock. And it's the overall market is moving, so the buyers come in. Or maybe the stock was going down and then there's some positive news comes. When the positive news comes, and then it starts to rise sharply. So what you're looking for in that kind of a reversal, you have to pay attention. Where is the support? You have to pay attention to the volume. You have to go into the intraday time frame, and go and act quickly. The longer you in intraday reversal, the longer you wait, the higher is your risk, and the quicker you enter, provided you're reading the chart correctly, the quicker you enter, provided you're reading the chart correctly, the more gains there is, because you're entering at the beginning of a reversal. And the result for the result of this kind of trade comes quickly, because if you're entering at the beginning of a trend reversal based on the intraday reversal action, if you are wrong, you're wrong, maybe same day or next day, very quick. So you in intraday reversal, maybe your because it's a short-term market shift. So maybe you initiate a trade, initiate a position with a little exposure, and as you get the confirmation, you scale then, because now you know that what you read 2 hours ago is valid, because the intraday reversal could be volatile and it's popular among day traders. So, and if you read the chart correctly on intraday basis, you can, especially in option, you can uh, create a fortune for yourself. So types of intraday reversal trading: key reversal, making new highs or low but close in the opposite direction. So there is a concept called key reversal. Key reversal, when the market makes a new high and now it's creating a new low. So let's say Microsoft gapped up and it's reversing. So not only is reversing, but it's reversing and it's now it's going below the gap up low. Now it's where it gapped up is crossing below. So it's a key reversal. You can take help with the pivot points. So pivot points instead of support. So there's a static support and resistance, which is based on the historical, and then there is a dynamic. So dynamic support and resistance, you can create some pivot points. So such as the formulas: high plus low plus open divide by 3, or high close open high divide by 4. You get certain points and then you draw the line, so you have a pivot point. And traders magically, because when everybody is watching the same thing, the market reacts psychologically the same. So if everybody is watching at a pivot point, the market just react also at the same price, which you are already reading it. So if you inject pivot point, then you create the lines based support and resistance line based on the pivot point, and other traders have the same formula. So everybody is applying the same formula. So it's like prophecy, it comes true. Now, on the intraday reversal, you can also, if you have mastered the candlestick patterns for reversal, so there are a lot of candlestick patterns which are bullish pattern, and then there are bearish pattern, and then there are reversal pattern. So you can, if you master these patterns of the reversal, you can apply these candlestick patterns on the reversal, when the market is reversing. So you look at it and you say, okay, I see this candle and I rely on it, and it's occurring at the right price level, and it's occurring at the right price time, and all the ducks are in the row, so I will go short or I will go long. So the beauty lies in the eyes of beholder, again, on a candlestick pattern. So short-term trading, you capture the short-term profit, you manage your risk, set tight stop loss orders, and you confirm your signal strength through volume and indicators to validate the strength of the reversal signal. So you have the reversal signal, you're identifying it, and then you're validating it based on some other indicators and volume analysis. So you're looking at all that. Now, again, there is a limitation. So false signals, intraday market doing the intraday reversal, and you go long or short, and then the market is stabilized, and then it goes the original direction. So it can happen. And when intraday reversal is happening, there's a lot of market volatility. So erratic price movements happening, which is influencing based on the news, and there's a high risk. So intraday reversal is a high risk and high reward trades, and you need to avoid over trading, excessive losses if not managed properly. So be careful when you are, because when you're doing the intraday reversal, you're making a quick decision, very quick decision. It's like you're fighting, you're up in the air and you are having a dog fight. So you belong to Air Force. Think about it, one little mistake and you're dead. So intraday reversal is you know, compared to that. I have written an article, and I will find and send you. So intraday reversal is just like a dead dog fight. So avoid over trading, excessive losses if not managed properly, and control your emotions in intraday because you're reacting quickly, and pay attention to internal your body, how you're reacting. So pay attention to your internal system. You may be reacting due to excitement and greed. So pay attention to the greed, the excitement, and maybe some kind of a regret you have. Either you missed out some trade or you did not close the trade at loss. So those greeds are thus there, and it's making you react to this trade, and you're excessively over trading in it because there is a greed there. So remind yourself that what I'm doing right now. So think about this. Now, the last trading system is a moving average breakout system. So moving average, so think about this, moving average is created based on adding, let's say 1 plus 1 plus 2, 1 plus 2 plus 3, and then divide by 3. This is a moving average. Or there is a moving average based on exponential. So you read the recent data and you drop the old data. So that's the exponential moving average. And then there is a weighted moving average. You give more weight to the recent day and you give less weight to the past days. So there are different kind of moving averages. And then number of days, 20 day, 50 day, 200, 41, whatever is your day. So these moving averages act as a dynamic support and resistance level. So now you're looking for some kind of a moving average support, and now the stock is reacting at that moving average, or there's a crossover going on. 50 days crossing above the 200 days, so that's a bullish. 200 days crossing below 50 days, that's a bearish. Or maybe the 10 days moving above the 20 days, that's a bullish. So all that moving averages, you have belief and you're trading that kind of system. So moving average is workout in a trend trading and a breakout trading. So the trend is already there and you're looking for some kind of a pullback on a certain moving average. Let's say you say, okay, 10-day exponential moving average. So 10-day exponential moving average is your support. The trend is already there. And when the stock comes down to the 10-day exponential moving average and it reacts, and you get the secondary evidence on a volume and it's going up, that is your signal. And then you see the bars, the volume coming up, and the bars are forming positive bars on the upsides, or the downside, the negative bars. So you are going long or short. Prices crosses above or below key moving averages. So the 10-day exponential, you're going short, and it's going crossing the 10-day, you're going long. So all that, you can do that. So the trading system you can develop is based on the moving average crossover. One crosses over the other. The moving average bounce. So if it touches the 10-day exponential moving average from top and it bounces, you act as a support or resistance. You go long or short. You can even create a moving average envelopes, just like the Bollinger Band or Donchian channel, you can create an envelope of a different moving average. So use two moving average with a percentage difference. So look at the moving average envelope on your trading system, and maybe you want to trade the moving average envelopes. So that's another kind of trading. So application in identifying trend continuation and reversal. So capture trend continuation. So you capture the trend continuation on a pullback to some kind of a moving average. You capture the trend reversals on a break of the moving average. And then you set the price target distance from the entry point to the next key level. So you enter at the pullback to the 10-day exponential moving average. Now you need to figure it out the distance, where it's going. Maybe that distance could be the recent high. Maybe that distance is the 2-week previous high. Maybe the you figure it out on an intraday level, where is the previous resistance. So you put that price as your exit point. So whatever it is, you need to have a way of setting the price target. If you don't have a way of setting the price target, exit, don't trade. So again, the limitation and risk management, false signals, whipsaw, leading to potential losses, market volatility. Moving averages can be affected by market volatility. So moving average, the market just become volatile, and it comes to that moving average, and then it breaks the moving average, and then it bounce up. And if it's breaking the moving average, then you're going short, and then the market just bounce up. So be careful. And then you need to combine with other indicators such as volume and strength of the move. So always a combination. So again, there is a risk there. So also you need to apply price and volume filters in uh, all types of trading. So price filters, volume filters, average true range filters, the percentage change in price in last X minutes. So you can apply the say this much distance have been covered in the during the last 10 minutes, 15 minutes. So I need to pay attention. You can do the volume analysis, the percentage change in volume. So if the volume is changing in the last X minute, spike in volume, what is happening? Is there a relative volume increase or decrease? What is going on with the absolute volume and relative volume? So all that needs to go into your trading. Now we have a swing trading. So I give you the features and benefits of my swing trading. So real trades, real time. I send you the real trades in a real time basis, which means I'm not giving you a trade which is, let's say I send you email tonight and say tomorrow you go long. I don't know what will happen tomorrow, so I cannot give you any I can't, nobody should know tomorrow this stock should be a buy or sell, because you don't know what will happen. We send you the real trades real time, and through email and telegram, and a specific buy price. We mentioned the buy price. I provide you 3 targets and stops. So I go through all that what I showed you in detail. I also provide a detailed fundamental and technical analysis. So fundamental analysis is there. You wait for after we send the alert, after 1 or 2 hours, I send you the fundamental and technical analysis of the trade. I post that on at my website, tradegenie.com. So you go to the blog and you can read my previous trades there. I send you daily lessons. I have created a lot of content, and I send you a lot of educational emails. So pay attention to the educational email. Those are have tons and tons of knowledge there, and it's right there in your inbox. In a lot of emails, I provide you the quizzes. So I developed a lot of quizzes. I spend a lot of time, and I'm doing it. I created the quizzes for these lessons. So if you read the lesson and you take the quiz, see where you stand. So you will increase your knowledge. I teach you 4 times or 2 times a week. So just like I'm teaching you right now. You can join my Facebook group. So if you don't know where it is, actually, I don't know. It's a Facebook page, Trade Genie. You go, there are 9,000 traders there. I have a YouTube channel called The Real Trade Genie. So you can subscribe to the YouTube channel, and all these lessons are uploaded there. So this lesson will be uploaded tomorrow morning. I have 30,000 Facebook page fans. I have created a trading system guidebook, and right now it's a 71 page, and I am adding more content. It will go to 150 or 200. So it's a detailed book, what I'm teaching and what I know into a condensed 200 page or so. Right now it's 71 page and I'm revising it, and provide you full support via email and phone. So you send email and or call, there is somebody to help you, and so all that. So there's no shortage of profitable trade areas. Trade having highest profit potential are sent. I do all the work. My team also do the work. They behind the scene. There's a lot of, I have a big team which are working and helping me in doing what I'm doing. But as you can see, I cannot do it. It's very hard for one person to do everything. So I have a team, and they are doing their work. So the objective is for the smooth and rising equity curve. You grow. You also learn while growing your portfolio. And the reason you need to learn while you're trading is to improve yourself. You improve your trading skill, like entry and exits and managing the trade. The more you learn, the more you increase your thought process, the more you'll be able to manage your trade, and then you maximize your own profit. So you may be, I may be, a trader may be exiting at a 30% profit, but if you're managing it properly and you're learning along the way, you may be exiting at 50%. So here is the detail. Email, you can email me at success@tradegenie.com, or one of my team members will respond. We're usually open 24 hours a day, 365 days a year. Here is the phone number, so you can call us 212-930-2245, and simply go to tradegenie.com and enroll under either a beginner page or experience page. For experience coaching, not coaching, the subscription, the swing trading is $13.97 for 7 months. If you don't want to enroll for 7 months, maybe you enroll for a monthly and then you convert into 7 month or yearly. So that's it. The last is my favorite, Bruce Lee. So trade like Bruce Lee. Um, so this quote was given to me 15 years ago by my mentor. So I was trying to learn so many things at that time, and buying books and everything. So he told me that you need to be like Bruce Lee, focus in one area and then expand. So focus and then expand. So Bruce Lee says, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So when you look at the market, so you know yourself, you know the market, then you master a few trading systems, few trading strategies and techniques, then you laser focus on few stocks, then and then you come, and then you put 2 plus 2 together. You say, okay, I want to go for trend trading, and then I apply support and trade resistance, and then I'm reading the volume, and then I'm entering the trade. So go trade like Bruce Lee. So if think about this, if Bruce Lee was a trader, if Bruce Lee was, let's say Bruce Lee was a trader, so what do you think Bruce Lee would be doing? He would have been he would have mastered through practice, right? He would adaptability and innovation. So Bruce Lee, think about that. Emotional mastery. Think about the Bruce Lee has an emotional mastery. Think about the Bruce Lee, his mindsets and beliefs. I mean, if you look at his video, I mean, how he does this thing, I I I miss him. Continuous learning. So think about how much Bruce Lee have spent his years in learning his thing. Bruce Lee, if Bruce Lee was trading, he would have been applying the robust risk management. Think about this. If Bruce Lee, I mean, first think about beating the opponent later. Worry about your own defense first. Think about the Bruce Lee adopting the patience and timing. How what was his timing, and what how I mean, and patience. So think about that, and read about the Bruce Lee's teaching, adapt or perish. So if Bruce Lee was a trader, what kind of a trader? I'm just wondering. Hey, let's see, if Bruce Lee was a trader, what kind of a trader would have been? So think about Bruce Lee when you're trading, maybe, or learning, maybe you increase your skills. So I just relate, if he was a trader, what kind of a trader he would have been, or if he was like this. So I want to be like him. These are some of the recent winners listed here, and that's it. So today's session ends. I taught for 2 hours and 25 minutes. I have created a lot of content. I've taught some already. They are on YouTube channel, so you can go on a Real Trade Genie and look at that. I have a lot of content, a lot of courses I'm preparing, and I have like 6 of them in pipeline. I'm just there, just few. tweaking, and I will teach you in six other things I have, and these are not available online. You cannot something you cannot even think of that I need to learn this. That's what it is. You cannot think that, oh, I need to learn this, really. So if no, if we don't know that we need to learn, then we will not learn. So that's the problem. Somebody has to tell you. So someone, so I've been doing it for 15 years. So I I'm constantly trying to figure it out what else I need to learn, because there is a limit to the technical side. So then you need to really master the risk side. Then you really need to master the other aspects of trading. So if people don't tell you, or somebody don't, or you don't figure it out, then you will not learn. So those are the other topics I have. I have tons of content on technical analysis. So I teach for 1 year. I have a 1 year coaching program. So if you're interested, send the email. I have a 1 year coaching program. I have an 8-day coaching program, which is very nominal fee. So if you're interested in 8-day coaching, send the email. I'm creating other coaching programs which are paid, and they are free. So free online courses. So this is a 2.5, and then I have created others. So if you constantly and regularly attend every and take notes, and then you listen to the recording on YouTube, you will learn a lot. So all right. So thank you. And I've been talking to you for 2.5 hours. My throat is dry. So I'll see you maybe on Tuesday. I will teach you another topic. So thank you.